Thank you all for joining. We're just now getting started. This is our fourth installment of the Eastern Market Training Series in conjunction with Lake Trust Credit Union. So today we've got a pretty good class today. We've talked about the financial statements. We've talked about the documents that lenders will ask if you want to get a loan. We've talked about how to build your financial statements. So let's talk about some of those other documents that you may also have to prepare if you needed to get a loan or if you wanted to speak with a lender. And that's going to be, we're going to cover up the sources and uses. We're going to talk about what that is. We're going to discuss what a personal financial statement is, if you're requesting about that. And then we're going to talk about a break-even analysis. And the break-even analysis, that's going to actually work really well in conjunction with the cash flow projection that we talked about last week, because that just sort of builds off of understanding your numbers, having financial statements, understanding your numbers. So now you've got a balance sheet, now you've got an income statement, and now you want to look at, well, what do these numbers mean to me? And that break-even analysis is just one of those analytical tools. There's actually as many financial analysis and ratios as you can come up with. People call them by a number of different names. They can be called key performance indicators, KPIs. They may be your financial ratios. So there's a number of different ways to be examining your financial information, and your break-even analysis is just one of those. So my name is Dale Grant. My company is Ashton Business Consulting. I work with small businesses around the Metro Detroit area. And once again, this is the Eastern Market Training Series in conjunction with Lake Trust Credit Union. And we're going to go ahead and get started today. I'm adjusting the camera because it looks like I'm going dark on the screen. Am I dark on the screen? Okay, perfect, good. So we're going to start off, actually, I'm going to share my screen, and we're going to start off with the break-even analysis. And let's see if I go to slideshow from beginning. I don't think that's what I wanted to do. Let's close that out. Oh, there we go. All right, break-even analysis. So let's get in here. This is just a little bit of information about me, how to contact me. We'll discuss our break-even analysis. So let's talk about what the break-even analysis is. This is a critical component of pricing. So just a quick word on pricing. It's not a hard science. It's a little bit of science. It's a little bit of art with pricing. And what do I mean by that? The market dictates the price. Your price is going to be what people are willing and able to pay for your product or service. I tell most of my clients when I meet them, more than likely, their prices aren't high enough and they're going to have to raise those prices. You should look around at who your competitors are, who is currently in the marketplace, and your prices should be either at market or above market. The way you do that, also, one other note on pricing is that you don't want to be competing on price, because competing on price is a race to the bottom. If you sell your cookie for $2 and the next guy comes by and sells it for $1.75, if your big selling feature is you've got the cheapest cookies in town, then you've got to go to $1.50. And so it's just a race to the bottom versus focusing on the value that your product or service brings. So, we've had a few classes. I may have told the story already, but it really came down to a client of mine who sold pies, and she realized that her competitors were selling their pies for a higher price, and they were using lesser quality products. So she didn't need to go out and tell other people, hey, they're selling you a lower quality product for a higher price. What she really needed to do was educate her customers on why her pies were better. She needed to justify that price. And you do that by talking about the value that your product or service brings. I use organic materials. Everything's handmade. I don't, it's gluten-free, whatever it may mean to you. So that's a lot of the art piece of pricing, understanding the value that your service or product brings. It may be that you have exemplary customer service. That can also be part of your pricing. The science of it is the break-even analysis. That's going to tell me how many units of a product must be sold to cover the fixed and the variable cost of production, plus my desired net income. So this definition I've just read is going to be sort of the overall theme of what we're going to be talking about today. When you're thinking about your break-even analysis, you've got three different costs or three different numbers you want to be considering. The first number is I've got fixed costs. I've got to pay for the rent of my building. I've got to pay for my staff. I've got to pay for my accounting systems. The next piece that you may have is going to be your variable costs, so your cost of goods sold. So for every piece of pie or every cake that I make, it costs me $1. So now I know I've got $1 of materials for my product, and then I know that I've got to sell enough product to cover my fixed cost. And finally, I have to reach a desired net income. So I also have to have that component in there as well. Yes.
The other competitor, of course, the same problem you said, but they've been more established than you, and their prices say like $3 more. What would you have to do to say, even if you advertise, to catch up to where they're at, because you have a certain client base that's what you're trying? How would you have that?
Well, I'm not going to look past the fact that, we all start off in business. So there's definitely a recognition that I'm the little guy, or people don't know who I am, or I need to have sales to get my name out there. So that component is going to be there. I think that once you establish yourself, especially for businesses that are smaller, that are niche, that are boutique, I think that you can make a run at the bigger guys, especially in food businesses. It's like, do I go to a big box store and buy a cake, or do I buy a cake from this amazing baker that, my friends told me about? So that goes back into talking about why your products are good. What is the value in it? I make my cakes like this. More than likely, especially when you're competing with a big box competitor, they're going to win on price every time because they can buy things at a lower cost, but they may not compete, but they're doing things on a mass production scale. Okay. And when you do things on a mass production scale, inherently you will lose some pieces of it. So I think that that's sort of your inroads, and that's where you're talking about that value. Sometimes it's, you know what, I'm going to cater. You're having a friend of ours had a very nice event, and they had they knew of people that made these really good desserts. So they said, hey, why don't you come and serve these desserts at this event? You can't do that by getting a big box store, but at this event, you can have a personal dessert table with caterers and people giving that kind of service. And it really just adds just another air to it. And people will pay for that all day long. We can just take one moment, less than 1 minute. So let's kind of talk about the numbers. that are behind the break-even analysis. So if you recall from the previous presentations, we've got our profit and loss statement, which is also known as the income statement. So those two names are interchangeable. This is a very high level look at a profit and loss statement. You won't see one that looks like this, but this one here has the key areas of the profit and loss statement. So that's going to be your revenue. That's all the money you bring in, less your cost of goods sold. That's what it costs to provide your product and service. So in this case, for you guys, it's going to be the ingredients. I even include the packaging. And if you are shipping it to people, I would include shipping and cost of goods sold. Shipping to customers, not shipping to you. That's going to equal your gross profit. So that's one of those analytical numbers in there. We want to know what our gross profit is. When we're looking at competitors, if you're ever so lucky to see another competitor's number and you can see what their gross profit is, you can understand how much they're paying for their cost of goods sold, and it gives you an idea of where you fall on that scale. And I have these conversations. I had one of these conversations today with the client. We did it in terms of talking about their labor costs, and they were paying too much in labor costs. So you want to understand your gross profit number. Less, so you take your gross profit less your operating expenses. Operating expenses is all the money that is required to run your business. So that's going to be the rent of your location. That might be, if you got a food truck, that might be gas for your food truck. It's going to be insurance, things of that nature. Less that equals your net income. So all these numbers, these are all critical components of your income statement or your profit and loss statement. These are just sort of those main areas that we look at. These are going to be some of the numbers that we're going to use today. We're going to make some key assumptions. Okay, so this is just for demonstration purposes. We're going to say that we sold 100 units. On our profit and loss statement, we had total revenue of $10,201. That means that each unit was sold for $102. So what's a unit? A unit is what you sell by the price. So if you sell a whole cake is 1 unit. If you sell a whole cake, cake's by the unit. If your competitor sells slices of cake, theirs is going to be, their units are each slice. So you got to understand that when you're thinking about your business, what does a unit represent to you? For me, I typically charge billable hours. 1 billable hour would be a unit. So it is, what is that thing sold? So once again, for most of you guys, it will be, if it's maybe you have a restaurant, it's a food truck, it's a whole plate of food, whatever that is, but that unit. And I understand that you've got a menu with a variety of items on there. So in that case, I would look at maybe average price sold. You may say, hey, I've got a food truck, and on average, I see 50 people a day, and usually I'll make about $13.25 per plate. Doesn't mean everybody bought the same thing, but that's roughly the average. Okay, so if you have to average, that will work just fine. We call our cost of goods sold the cost it takes to make that thing. We divide that by 100 units sold, $36. So on average, every time I sell something, I sell it, I receive $102 of income, but it cost me $36 to make. I've got $60, I've got $66 left. Out of that $66, I've got to cover my fixed cost, rent, insurance, gas for my food truck, and I've got to keep some money for myself so that I can pay my bills. So that's the crux of that number. And what we're getting at is how many sales that I need to make on a weekly, monthly, or annual basis in order to not only break even, but to reach my desired profit. So how many cakes do I need to sell? How many slices of cake do I need to sell? How many billable hours do I need to provide? How many of my units do I need to move? So this is, and so this slide here is how to do the break-even analysis. And the way that I've got it here is that it's first written out, and then I'm going to show it to you with the numbers. And I intended to say this at the beginning of the presentation, but I'm going to say it now, is that this presentation, you'll understand break-even analysis, but it's really just to give you an introduction to it. You can follow along with it, but if you have questions afterwards, that's typical. And that was typical of when I learned it the first time too. So, don't be intimidated by this at all, or expect to, that you would have to walk away with a complete understanding of how to do your own break-even analysis. This is just sort of to begin to spark that point to ask those questions. So we have our break-even point in units. That's the first thing we want to understand. Once again, how many units do I need to sell to first break even for the month, cover all of my cost of goods sold and cover all of my operating expenses? I'm going to take my total operating expenses, and we get that. Remember, all of these numbers go right back to our profit and loss statement. So our total operating expenses are $2,600, $2,684 divided by my gross profit margin, revenue per unit minus cost of goods sold. Right? So that's going to be our revenue per unit minus cost of goods sold, our 66 bucks. Here's our 2684, our operating expenses. And then we divide those two numbers. We took our total operating expenses for the month of 2684, and we divided that. Remember, our $66 is what we were left with after we sold our product and we paid for the ingredients to make it. What that tells us is we need to sell 41 units. Out of that, from that $61, if I do that 41 times, I will at the very least cover my cost for the month. Okay, now I'm really making, what is my break even in sales? I take that same $41 and multiply that by my sales price. I need to make $4,000. If I make $4,100, then after I pay for my products to be made, I'll be left with $2,684 to cover my expenses. However, I still need to pay my bills. So this is the same thing. Revenue per unit times the break-even unit in points. And then you can take this number here, this 41, well, regardless, before I do that. So now our profit. So now what I want to do is I want to take my total break-even sales, which I now know to be $4,180, and I'm going to multiply that by the desired net profit margin, right? So here's a little math trick. If you want to do, say, 20%, instead of multiplying that $4,100 times 0.2, that's just going to give you 20% of $4,100. If you take $4,100 times 1.2, it'll give you that $4,100 plus the 20%. So try it out when you get home. I'm a nerd. I like to do little math tricks. Let's see here and go back. Desired gross profit divided by my gross profit equals my gross profit margin equals my additional units to sell. So let's go back. I'm going to add net profit of 20%, right? So we've got our gross profit margin. We know that our gross profit margin is 66% because I've taken my gross profit of $66 and I've divided that by 100, just for percentage purposes. If I take, let's see here, this additional units to sell, I want to take my operating expenses for that 20% and multiply that by 1.2 so I can consider my net profit. And then I'm going to take my total operating expenses. So that 20%, think about it like that. I'm adding that 20% on top of my current operating expenses to cover my salary or my desired net income. So really what I need is $3,221, right? Because $2,600 takes care of my business expenses, and that other 20% takes care of me, my net income. So that's $3,200. I'm going to divide that by 66% and get $4,800. Subtract that from my $4,100, which was my initial units I needed to sell. I have $698. I divide that by my gross profit margin and I get 10.5. I need to sell, we'll round that up, 11 additional units, okay? And so I always feel bad going through the math. I don't want to rush through it. As you all know, this presentation will be made available to you. Christine will make this presentation available to you afterwards. But if you follow along with the sequence, essentially, we added our 20% onto our operating expenses. We divided our operating expenses by our gross profit margin to understand what number we would actually need. Subtracted that from our break-even number of $4,100 and this additional 700, that's how many units we need to sell. The 700 divided by the 66, the 11 units is the additional units to sell. So what we were able to do is go through an exercise that helps you to understand how many units you need, how many of your things that you sell on, I like to think of things on a monthly basis. So we'll say on a monthly basis, how many units do you need to sell on a monthly basis first to just break even, right? And we decided that was 41. And then for us to make a profit of 20%, we need to sell an additional 11. Okay, so we really need to sell 52 units. So now I know, okay, on average, I need to sell about 12 units a week, you know, or maybe I need to do it on a weekend or during the week or something to that effect. But you can begin to break down these numbers as to where you need to be in order to reach your goal. So as we talked about in the beginning, remember, pricing includes the cost to make your product or service, that's our cost of goods sold, a portion of the cost to run your business, plus your desired net income. Okay? So that's going to conclude, well, let me ask this first, because that's going to conclude our portion of the break-even analysis. Does anyone have any questions before we move on? Okay. I'm going to pause this here. Let's see. Let's X out of here. And I'm going to stop my share for a moment while I get my screen together. Let's see. Marie, did you have a question? You have to unmute yourself if you do. There we go.
No, I understood everything. It's just I could not see it as you were going on the screen. I just had the first screen the entire time, so I didn't really see how it was done. But I'll get it in the next video, I guess. When.
Okay, I'm gonna share that, and we're gonna have to look into that because I want to make sure the Zoom comes through clearly. So,
okay.
Thank you for letting us know that. So now I want to go into, yes, thank you. So let me share screen. And now, so let's talk about our sources and uses. So in the event that you guys have decided to go for a loan, your banker, your lender is gonna ask you, they're definitely gonna ask you for financial statements and for tax returns. They may ask you for a cash flow projection, which we discussed previously. They're also going to ask you, how are you going to use those funds? So this is a form, or this form here is actually not at all difficult whatsoever, but there's more or less for us to talk about. This is the sources and uses form. And I think that even if you don't have to fill out a formal version of this. In the event that you go to request a loan, I would like for you to have this knowledge in your back pocket so that you can answer those questions. This form is very much how the title implies. It is how are you going to use these funds. So this specific form, and I'll make this available, but it kind of requests that you put in numbers here. So let's say, for instance, you were going to ask for a total of $100,000. You may, I'm not going to go through here. You may ask for a total of $100,000. This form helps to plan out how you're going to use that money. You may say, okay, well, I've got personal capital of $10,000. So I'm going to put that up. And then I just got lease space, so I need to have a leasehold improvement. And I talked to the architect and the contractor, and they told me that was going to be about $30,000. And then I've got to get some equipment, and that's going to be another $40,000. And then I've got to get insurance, and I got to hire a guy, and I just got a bunch of expenses, and I don't know where that money is going to come from. So I'm going to ask you guys for some working capital. That's $100,000. So now you've been able to go to the lender with a clear picture of how you're going to use the funds. The process of getting a loan is you meet with the loan officer. They're going to kind of mini interview you. They're going to find out about your business. They're going to ask you how you're going to use the funds. If it looks good, they'll take your information and they'll give it to the credit analyst. They'll ask the questions. It goes to the loan underwriter, but then it goes to the loan committee. Okay, loan committee is who you actually get the loan from. All right, and this is higher ups. You'll probably never know who's on the loan committee. It'll be 5 or 6 people, and they're going to discuss that loan with the loan officer, utilizing the information that they receive from the credit analyst and the loan underwriter. And I say this because I want to make the point that it is critical that that loan officer be on your side. Okay, so by giving them the information they need, being upfront with your plans, showing that loan officer that you have a very clear idea of how you're going to use those funds is key, especially in getting them on your side. So I think that's important. Here it looks like I actually did this incorrect. So I'm going to change this just quickly while we're talking for demonstration purposes. And it's my uses. So sources would be owner, and then we may have lender. Okay, we may have a HELOC, and then we'll say, and then line of credit. All right, but here it is. This is sort of outlines your plan and what it is you expect to do. Also, as you notice, one thing that we talked about is upfront capital. That is also important because lenders are going to see if you've got any skin in the game. If you've got some money, it may not be $10,000, it might be $1,000. Okay, they're going to, especially if you're working with, I really like the community-based lenders. We've got a really good network of resources in the city of Detroit. If you go on bizgrid.org, you can find a ton of resources, but there are a number of lenders who are just available for you. And it could be, large organizations, it can be small organizations. It's about finding the right fit for you. With the small organizations, some of the CDFIs that are around, those are great for people who they do character-based lending, so they may not look for your credit score. The interest rate may be a little bit more. The larger institutions, they may go harder on the credit score, but the interest rate will be a bit more amenable. One of the things that I learned going through the pandemic and subsequently applying for PPP loans and SBA loans was that it is a good thing to have a relationship with a large financial institution because they're going to be first on the list with regards to monies that are available, and then they're going to go to who's ever first on their list. So those people that have established a relationship, a banking relationship, and an early banking relationship can be something that is described as simple as a depository relationship. We're just putting money in. You know, but now you've got an end where you can go and say, hey, I've got this checking account, savings account, I've been with you guys for 4 years, I've got a viable business, and I see that you've got loan programs, and I'm interested in speaking with you further about it. So this right here, the sources and uses sheet is another one of those tools in your toolkit. It can also help you with your planning as well. Coming in and understanding that, hey, this is how I want to use these funds. A lot of times people want to get business plans. Business plans are good. They are time intensive. I don't personally like to do business plans because they can be time intensive to do. But really the lenders, they want to know the numbers. How you use the money? How much money are you currently making? Is this going to increase the money that I get? Now tell me the narrative. Okay, well, why is it that you can be successful? What's that value proposition that you offer? What is your management, what is your management structure? What experience do you guys have? So that's really the main parts of that business plan. And source and uses sheet is a main part of that. We'll stop here, and we're going to go into our last document. I see some people have recently joined us, and that's fine. We have our Zoom being recorded, and we will be providing that to you. There was a PowerPoint with regards to break-even analysis that will be shared with you, and so will the source and usage sheet. This document is the last and final document that I'm going to discuss today. This is the personal financial statement. So this is one that's sometimes requested. So like I said, your financials, your tax returns, that's all the time requested. Sources and uses, that's a good one to have when going into that meeting with the lender and really letting them know you've got a plan in place and what your expectations are with the funds that you're requesting. So that's sometimes discussed. The personal financial statement, this was a toss-up. And sometimes lenders ask for it, sometimes they don't. This document, however, this document is specific to you. Okay? This particular one, you're gonna have your part, and also, this document is for the owners. So let's just sort of talk about that for a moment. Even though you have an LLC or a partnership or an S corp, even if you got a C corp, if you are applying for a loan, you most likely will need to provide a personal guarantee. A personal guarantee says that you personally are responsible for this loan. If you go and apply for that loan, they're going to use your credit score. One of the terms that I hear a lot on social media is business credit. I don't necessarily ascribe to the idea of business credit. Dun & Bradstreet is a real thing. I've got a Dun & Bradstreet, a DUNS number. You can report it on it, but it's not necessarily business credit. I couldn't necessarily go out and buy a car with my DUNS number. I've still got to give them my social. And what that really speaks to is that you are going to be personally liable for any loans that you receive. Now, could someone come along and prove me wrong? Possibly, but in all the cases I've seen, and I've had this conversation with bankers as well, the personal guarantee will stand until you get to be the GMs, the Fords, the Amazons of the world. They're not getting, it doesn't even have to be that big. Some of the larger organizations that are around here, but significant and larger organizations. For right now, so you will be personally guaranteeing that loan. The personal financial statement, the guarantees will be provided by all of the owners of that business. So if you are in a partnership, if you are in an S corp, and you have multiple owners, with an S corp, ownership it varies differently. With the S corp, it would probably be the more than 20% owners, or at least the higher percentage owners. With a partnership, definitely the managing members. The operating agreement may drive who signs it, but ultimately, the personal financial statement will be included. So up here is just your regular information. Also, when getting a loan, you can include, if you have a regular job, a W-2. So you can look at the income that your business receives, and you can, a lot of times, the lenders will look at your additional employment income, and will add that into consideration if you qualify for any loans. So up top, we started with our financial information. Section 3 is the main information for the personal financial statement. So recall, we've got our business financial statements. If we've done our job correctly, then the assets that the business owns will be reflected on that balance sheet. And it's key that I say correctly, because there's a lot of times where you see financial statements and maybe someone engaged an accountant after they had been in business for a number of years. They may have equipment that is not listed on that balance sheet. So that's my job to look into that and see if that's the case. You as business owners, you guys need to be aware of that as well. If you've got some assets, some business assets that isn't on your balance sheet, you should work to get it on there. Here, on our personal financial statement, these are our personal assets. So I want my personal checking account, cash on hand in the bank, and it's just gotta be as of the date. They just want a roundabout number. I wouldn't do it on a day where it was payday and showed all of my money, and I wouldn't do it on the day when I paid all my bills. I just kind of find a day where this is about what I got in my checking account, and I feel like this is representative of what I have. IRA and other retirement accounts. So that's an asset. 401k. You can draw on that asset. You can do an early withdrawal. You can get a loan from that 401k. So that is an asset that you would list. Securities. So anything that you may own, bonds, securities, things of that nature, stocks. If this says partial interest in real estate, even if you have an interest in real estate, and this was actually incorrect, it says partial interest in, it's not what it's going to see. But if you have an interest in real estate, loans receivable. If someone owes you money, and not just someone that owes you money, someone that owes you money and that you actually provided them an enforceable note. So you guys each signed a note and they said, hey, yeah, this person gave me $30,000 to start my food truck business, and I'm gonna pay them back over the course of 5 years at a 5% interest rate, then I would include that on here. If it's not to that degree, if it's just your buddy, your nephew, you gave $1,000 to get some studio time to start his album, I wouldn't necessarily count on getting that money back. And I would not list it as an asset on my personal financial statement. Automobiles, so once again, personal automobiles that you own. Other personal property, so if you have, maybe you have expensive jewelry, maybe you've got, an expensive watch or a ring or something to that effect. I know someone who had gotten a loan and they actually put up furs in jewelry before. And so that can be a real thing. So if you have something of value, and you think would put you in a good position, you could list it there. And then of course, if there's other items that you want to itemize. But then over here, we've got our liabilities. So who do we owe? Secured loans. So, that's gonna, well, down here we've got mortgages. So up here in secured loans, probably an auto loan would be, so secured is if it is secured by an asset. Unsecured is if you just got a loan and there's no asset that could potentially be repossessed. So anything that, if you got a loan, maybe you bought a Kubota, or, you got something like that, or you got a loan for a Dell computer, even if it's just $1,500, it's still a loan, it belongs on there. Same thing for unsecured loans. I would include credit card debt. Credit cards are unsecured loans, they're lines of credit. So just, once again, whatever date you chose for that cash on hand for your checking account, that would be the date of my personal financial statement. And so anything like that, another line of, if you have a separate line of credit. Due to brokers, I don't, that's more if you have stocks. If you buy stocks on what's called on margin, meaning you get them on loan, and technically, and you're doing short selling, that's what that would be. And then accounts payable to others, it's the same deal, as secured and unsecured. This is just the banks, and then this is just more personal. Accounts and bills due, I don't know about this one. I don't typically see that line. I wouldn't necessarily enter in my cell phone bill. I would only enter in on this line something that is due for an extended period of time. Maybe, I'm paying on it over the course of 6, 7 months, 12 months. I've made some sort of payment arrangement. If you have made tax payment arrangements, that will go there. But this wouldn't be, your phone bill or your DTE bill or anything like that. Real estate mortgages, unpaid income tax, and of course, other unpaid taxes. The equation on here, this is gonna add up both your total liabilities and your total assets, and then come up with a net worth. Essentially, it's gonna say, well, what do you have, how much cash do you have, and how much, how liquid could you potentially be, and then how much you have left over if you had to pay everybody off tomorrow. And so that's also going to be a deciding factor with regards to lendability and if you can get a loan. Just your personal net worth, it kind of shows how much you're in debt or if you're not in debt. So that's something to keep in mind. And also, excuse me. These forms that I'm sharing now, you don't have to wait until you're looking to get a loan or someone else has asked you about this information to pull it out. I would pull this information out and go through it, one, shortly after this presentation because it'll be fresh in your mind, but also kind of give you an idea of where you're currently at, especially if you're thinking about getting a loan. You might be at the point where you're saying, you know what, I'm doing good now. I might look next year for a line of credit. Good, I like that. Take a moment to assess where you're currently at. See what your net worth looks like, what you look like on paper to these lenders. Give yourself that 12 months, that 18 months, if you need to correct something, if you want to change something, if you want to pay down some things, in order to implement those goals, strategies, when you go, you put yourself to make sure that when you go, you put yourself in the best position. Same thing with that sources and uses fund. If you look at that, initially I said, there was some working capital, there was some equipment, there was some leasehold improvements. That's sort of a framework, a goal that you may want to work, towards. You may want to drill that number down more. And you say, okay, at the beginning of the year, I thought I was going to need $40,000 in leasehold improvements, but I've been, talking to people in forums and going on Pinterest and DIY and stuff. I bet you I can get that number down to $20,000. Throw that in there. See how that changes your decision making and what you think is important. So you can also use these forms just to help your internal management and planning. Same thing with the cash flow projection that we talked about last week. The great thing about Excel is if you got it in there with the formulas in there and it's working right, at that point, once all that stuff is working right, you can just easily take in and put in new numbers and kind of see what that looks like. So you can begin to play with it. You can kind of see, okay, off of an $80,000 loan, I found a loan calculator, a loan amortization calculator, and it said this is how much I was going to have to pay back, but this is what a $50,000 loan looks like. And I still think that I can generate X amount of dollars of revenue. And when I throw that number into the cash flow projection, my numbers still look good. You don't have to use these forms. So you don't have to use these forms just because someone has requested them from you. You can use these forms to help you make the financial decisions for your business. We discussed the asset liability section of the personal financial statement. The next, we've got sources of income for the year end. So this is just going to be your W-2 income, any commission you may have earned. Maybe you've got some additional real estate income. They've allotted the space here. You've got some rental properties. Maybe you've got some dividends. For those of us that have bought a home, getting a loan is the same thing. They want your debt to income ratio. They've got a number in mind that they want to see you hit. And then of course there's a loan to value ratio which you won't have. But that will play a part with what what you use that loan money for. Any other income, you can include alimony, child support, veterans disability. So they just want to get an idea of total income coming in, and that's going to help lenders understand how much debt service you can really take on. So maybe your business isn't profitable, or it's only making a couple $1,000 annually. That doesn't mean you can't get a loan, okay? Especially if you have disposable income. I paused because I was going to at first say high income, but you can have high income and a lot of bills. You have low income and be a lot more manageable with your money. So it really just comes down to that disposable income. But regardless, so we've got our various sources of income, and then of course, if there's any other liabilities that we did not include up here, they're going to want to have that disclosed. They're going to want to have that disclosed. And finally down here, one thing I didn't notice. Let me see. Oh, okay. So one thing I didn't notice. I glossed over this. Oh, okay. So it was. I think I glossed over this in the asset section. Cash value of life insurance policies. You may have a life insurance policy that can be surrendered and that will that you can receive cash from. So if you have one, you're probably aware of that. If you don't, check. That will also be listed. And of course, down here we've got the Schedule A, Schedule B, Schedule C. And it's funny because every time I see these schedules, I think of tax returns, but they're just referring to these other sections. When I saw that up here, it says Schedule C, and I was like, no, real estate would be on Schedule E, but they're talking about it corresponding down to this part. So if you see where it says Schedule A, Schedule B, Schedule C, Schedule E, this is for you to come down, itemize out what you've given that value to. So you've got to list all those assets that you've got, X amount of dollar value. They're going to ask you to provide essentially not necessarily a full-blown supporting documentation, but we need to have more information on here. You just can't kind of stick a number on it. But with that, this is your personal financial statement in which it provides information with regards to the assets that you have available to you, and of course the liabilities that you owe, leaving behind what your net worth is. So with that, does anybody have any questions with regards to the personal financial statements? Okay, so I'm gonna stop sharing my screen. So we're a little bit ahead. It's 5:49 now. We've still got about 10 minutes. So just overall, was there anything that anyone wanted to go over or had any questions about? Yes, ma'am.
I did have a question about the break-even.
Okay. Okay. Let me see here. So our question is because, where did I X out? Don't tell me I X'd out of the break-even analysis. 1 second, I did not. Okay. Well, it's I can see it here. I'm just trying to get it so that I can share it.
So if you see it, then just click on it.
But I'm not, okay. But Marie, can you see the thank you screen or the break-even analysis? Or do you see my smiling face?
Yes, I see you smiling face.
Okay.
Okay,
So now it's coming, I think, yeah.
Now you have the thank you screen?
No, I have Will Branch making videos, culinary store concept.
Okay. So we're gonna stop that. And then, here we go.
there we go.
Okay. So the question was just an overall question of the break-even analysis. So we're going to take this next 10 minutes and kind of spend some time looking at that. So did you just want an overview, or did you have a specific question?
No, just an overview, please.
Okay. So once again, with the break-even analysis, so the main parts that I want you to understand is that you've got the three critical components, okay? And that is you've got to cover your cost of goods sold, which is the cost to provide your product or service. You've got to cover your fixed costs. So that's going to be your operating expenses. That's going to be repaying that loan we just talked about, your rent, all of that. And it's just a fraction of the operating expenses. And then you've got to make money for yourself. Okay? So if we come down, so the main parts that I like to point out is that if you have financial statements, a lot of that information is going to come from your profit and loss statement. So our revenue, our cost of goods sold, our operating expenses, our net income. So in this PowerPoint, as we go through the examples, the numbers that I'm using in the PowerPoint is coming from this sampled profit and loss statement. And then, of course, I made key assumptions being 100 units sold. What type of product do you have?
So I do baked goods.
Baked goods? And how do you sell them? Do you sell them by the piece, or do you sell them by the dozen, or?
To my stores, I typically sell them by the dozen, but when I do the market, I sell them by the piece.
Okay, so in her example, she has baked goods, and wholesale is by the dozen, and direct to consumer is by the piece. So for you, you may want to have two separate break-even analysis, and then kind of understand what your product mix is, right? So yours might be a little bit more complicated, because when we look at units sold, right, I have to use by the dozen on units sold to determine, when I have to look at that gross revenue. So I would want to look at what revenue do you earn from your wholesale business, right? And then divide that by your price of the dozen, and then that would give me one number. And then I would look at the revenue you earn from your direct to consumer, and divide that by your units sold, and that would give me a different number. Okay, so that's one piece there. The second piece, I would probably looking for an equation for a product mix or a percentage of sales for each category. So I would want to know, well, out of my total revenue, how much of that is wholesale? Out of my total revenue, how much of that is direct to consumer? And then as an aside, you're also going to want to know that gross profit margin. I have a client that has a similar business model, and what we found is that direct to consumer is more profitable. So you would find that out by looking at your own gross profit margin, where you're looking at it and saying, you know what, I'm selling, by the dozen, and yeah, it's $20 a box, but each piece costs me $1 to make, and so that's $12 cost of goods sold, another $2 for the box, that's $14. So I only made $6 on this. Where I've got my direct to consumer, I sell it to them for $2 a piece. All right, it still costs me $1 to make, but I don't have a box, and I've still made $1. And so if I sold 12, I've made $12 versus that dozen where I think we came up with $4 or $6. Okay, and so you do that by going through the practice of understanding what those numbers are. So I would think that for you, I would separate that out instead of trying to meld the two together and figure out the math. It'll just get more complicated. What I like to tell people in general, as it pertains to accounting, and I use this myself in my practice, is I try to keep things as simple as possible. Accounting is inherently complicated enough. And the same thing with business, with everything that we're doing is inherently complicated enough. There's no need to add more complexity to it. So if I can make something simpler, if I can just kind of break it down so that it's easier for me to digest that information, it helps out tremendously. So just by hitting on key points, this one was a good one. So on that break even, remember, we predetermined from our profit and loss statement, and that's going to be on there on your income statement. Okay, on your income statement, you're going to see top line revenue, especially if you've got QuickBooks. You've got top line revenue, and then it will itemize out your cost of goods sold, and then you'll have it'll be bold and clearly what your gross profit is, and then right underneath there are your operating expenses. So it's a standardized format. They all look the same. So you'll be able to clearly see what your operating expenses are. You have that number, you understand what I need to, at the end of the month, I need to sell enough units to cover all of my operating expenses. Okay, fine. We've calculated our gross profit because we've got our top line revenue and we've subtracted our cost to produce and package the product. And yes, I am talking about packaging a lot because people forget about it, but in your business, packaging is a lot, okay? So you want to make sure that you are properly budgeting for that. So for every time, so in this equation, every time they sold something, they made $102. Revenue, just gross revenue, they collected $102. Let me take that back. But they had to account for the $36 they spent making that product. Leaving them behind with $66, okay? Out of that $66, they still have to cover a portion of their operating expenses. So when we divide our total operating expenses of $26.84 by the $66, the money that we have left over, we see we have to sell 41 units. So once again, units is a vague term. It's whatever you sell at your price, whether it be slices or by the dozen. If you have to split it up, you could do that. But what we know in the operating expenses, those are pretty much fixed costs. You want to try to get away from that fluctuation. Rent is the same rent every month. Insurance is the same insurance every month. If you're getting bank fees, that's going to fluctuate. Parking is going to fluctuate. So you want to try to get it as consistent as possible. But if you can, it can help you plan for it. But we know now we need to sell 41 units. We need to have sales just to break even. We haven't made any money. We multiply that 41 times that revenue, that top line number. I need to have $4,100. That covers my cost of goods sold and my operating expenses. Now I need to add on my 20%. So that's where that comes from. Right? That 20% in this particular example, and I've seen different ways to do the break-even analysis. They're very similar. It's just very different, small differences in the equation. In this particular sample, we're adding on that 20% to those operating expenses, those fixed expenses, right? I need my 20% every month. So I need $2,684 for expenses, plus I need an additional, I think this is $689 a month for me, okay? So that's where I'm adding in that 20%. And then I'm dividing that by 66%, which is my gross profit margin, okay? And that tells me, and this is once again one of those little math tricks. If you divide a number by a percentage, you'll see if you divide a number by a percentage, it will tell you what that number is a percentage of. So in other words, by dividing 3,221 by 66%, it tells me that $480 is 66% of that. I said that all wrong, but this is the equation. You take your 321, which is your 20% plus your operating expenses, and divide that by your gross profit margin. Okay, and we got our gross profit margin by dividing our gross profit by our revenue, which is on the previous slide. We took our gross profit divided by our revenue. And that's what tells us that we need to have sales of $4,880, okay? And then I can just divide that, I can just kind of break out that number some more. But eventually you see we get to 11 units sold, okay? Does that help out? Yeah. Okay. Good. And like I said, we're going to have this available so you can go back and look at these numbers as well. Does anyone else have any other questions? Okay, perfect. Well, that's going to conclude, let's see here. That's going to conclude today's presentation. This was your break-even analysis, followed by your sources and uses, along with your personal financial statement. This was done by the Eastern Market Corporation in conjunction with Lake Trust Credit Union. My name is Dale Grant. My firm is Ashton Business Consulting. Next week will be our last presentation. We are going to discuss taxes and record keeping. So I'm going to go over federal income taxes and also what are your state and local potential tax liabilities, as well as sales tax, and then we'll have a piece on record keeping and how long should you keep documents and what kind of documents you should be keeping for your business. So with that, I hope everyone has a great afternoon, and thank you for attending. Take care.